Welcome, everybody. Today, we are talking to Chris Booth. He is a banking and finance legend. He's been at the top of the industry for over 25 years and is now the CEO of Australia's one of Australia's fastest growing mortgage broking businesses, Lydian Finance. Chris, thank you very much for joining me on the show today. We've spoken a few times. It's been a while, and it's been a pleasure watching your business go from strength to strength. Spotting a new goatee. Welcome to the show.
I don't know what to say. Is that you talking about me? you know what? Look, the energy, the enthusiasm. I mean, that's all. Look, Lydian's all about exactly the same, mate. We're trying our best. We are, like you said before, we're growing. It's been a real whirlwind in the last 2.5 years. She's Lydian. She is, she's a teen coming into her kind of early adult years. And with that sort of acceleration of growth, we've got more brokers nationally, we've got more partners, the financial planning connections that we've had previously and the new partners that are coming on board. It's been really exciting, and I'm really humbled to get the support from all of the people which I've known previously, but also the peers in the industry who are willing to trust their clients and relationships for lending to Lydian and our brokers. So it's been great, mate. It's been really, really, really good. But thanks for the pump up.
Chris, one of the reasons why I love talking to you is because there are things that you pick up when you've been in the industry for a long time. You get to sort of rub shoulders with different industry executives. You get the inside line. And I know whenever I've got a difficult loan, which is normally my own, I can call you and have a very frank conversation, and you'll give me the sentiment of the banks. There's the policy, there's what's written, there's what's advertised, but then there's the backroom chat. There's what the people in the background are willing to do and where they're going to. And I guess what I wanted to ask you is, what's the market sentiment? How are you seeing things in that finance space? Where are we going? What's happening with lending front?
Yeah, I mean, that's a really good question. So there's probably two pockets of people right now. You've got the people who are really sort of rate shopping, price sensitive, cashback offers, right? And sadly, the market has all kind of fallen into that space where they feel they've got to hotly contest, new clients, new to bank clients, which is such a shame when many of the banks have got great clients. And if they sort of worked a little bit harder to provide better rates and better service and better relationships, they would retain them and not lose them to this kind of crazy market right now. And personally and professionally as a mortgage broker, I really don't like the taste and the sentiment of the cashbacks and buying clients in that manner. So, but there's a lot of clients out there who they feel it's appropriate to change banks every sort of 12 months, 2 years. There's a lack of relationships, as I said, with many of the lenders, and the brokers are in the thick of it, because we still genuinely want to give the client the best rate for the loans that they've got. But whereas I suppose where we come from a different sort of angle and lens to this, for me, when I'm talking to my brokers and to my partners being mainly financial planners, we're all advice driven right now. So the majority of the clients that we're looking after, although we're driven towards best rate, best product, cashback offers as well, we're looking at restructure, cash flow, budgeting as our primary advice. Our brokers are doing a lot of work to make sure that our clients are focusing on their non-deductible debt, paying P&I on that. If cash flow is tight, we're looking at sort of re-extension of term. So, take a loan back out from 20 years to 30 years if it's appropriate, and get that cash flow back in for the clients. Because a lot of our clients are, mums and dads, a couple of kids, a lot of expensive bills, which have really ratcheted up over the last 12 months. So we're really trying to get that comfort level in their budget to set them back on track again. And the last thing, which is the most important, and the credit environment has really fallen foul of this policy, which was implemented in sort of these macro-prudential restrictions a few years back. A lot of clients who are looking to who've got deductible debt should be paying interest only on that if they've got their PPR and non-deductible to focus on. And the application process for that has got quite complicated. It is a credit application, but we're actually working again quite hard to start restriking the debt in the appropriate structures. So make sure your investment debt is interest only and you've got that in place. PPR, let's drive that down. P&I interest, principal and interest repayments, have an offset feature, and get the cash flow structure in place again. And and that to our benefit, and the advisors who are supporting us with relationships with their clients. So that's what we're working on pretty hard right now. And interestingly, just to go on to a sort of a segue around lenders, what that means is that we're making recommendations for the first time in my 15-20 years of banking to non-prime lenders, because they've got flexibility around servicing for clients who are looking to have cash flow and restructure in that process. Yeah. So if I gave you an example of $500,000 home loan paying P&I, if it's an investment debt, you're going to be paying sort of just over $3,000 for that. We can sort of save you maybe $600 a month by getting that interest only. The interest rate might not be the best interest rate, but you're still saving $600 a month in cash flow, which is probably more appropriate. And remember that interest cost is also deductible as well. So that's something we're seeing quite a lot right now.
Chris, you said a lot of really important things there, and you can pause, and each one of them is a really nice dot point for people that are trying to learn about the banking environment. One thing I noticed is one CBA have basically said they're not going to do cashbacks, and some of that they've said they're going to peel back on that, and they're just, you want to bounce around, that's your business. But what I really like about what you said is it's not all about rates, and everyone in a rising interest rate environment, they're looking to try and find the best rate, jump, change, move, downward interest rate environment, same thing, but it isn't all about rates. You just mentioned advice around structure. And this is something that I learned in, you and I have known each other for more than a decade. And when I was in the early years working alongside you buying property, you taught me the value of structuring your debt in the right way and managing your cash flow. And I think managing your cash flow is one of the most important things that you can look at in this environment where debt is relatively more expensive than what it was, and making sure that you're getting the right advice and appropriately managing that debt. Non-deductible debt, pay it down. The deductible debt, have a chat to your accountant and structure it correctly so that you can reduce the amount of tax that you're paying. You can structure it interest only, reduce the amount of cash that's coming out of your bank account. And as you just said, you can redirect that surplus funds back to your non-deductible debt environment. So the big lesson in there for anyone out there is don't chase rates. Chat to your mortgage broker and find out if you're doing the right structure for what you're trying to achieve. So
100%. Yeah,
really well said.
I'd even add an extra layer on that as well. Like, putting an old hat on. 10 years ago, we didn't have Uber Eats. We didn't have the access to sort of instant, food, beverage gratification. Okay, we didn't have all of these costs in our budgets, like apps and all that kind of stuff. So another thing we're doing with in tandem with our financial advisors, we're stripping out the the expenses over the last 12 months, having a look at that with the client and a clear lens. What are some of the things that we're probably overpaying for? How can we get your budget back to something which is more reasonable now that you don't have the flexibility of a 2% interest rate on your mortgage? Right, we've just kind of got a little bit lazy in looking at budget. We've fallen foul to the new sexy thing being an app, TV shows, channels and things like that. I think it's a great time now to go through your credit cards, go through your expenses, cut out the crap, and then look at what your baseline and your budget is, as well as going back to your debts as well. So for me, like I said before, we're working with advisors, and the people I've been working with for many years, and that's a lot of the conversations that the advisors are having right now, is having a tough conversation with husband wives about spending.
I can imagine it. How many fucking subscriptions have we got here? Why is there, Netflix, Stan, Disney Plus, Pornhub? What are these subscriptions? What are all of these things that we're paying for that we may not even be using? I look at that inside my business as well. I've got 100 different subscriptions, and you're going to say, well, where's the audit in this? I haven't used that for 6 months. And personally, you can't afford that little drip. And you might say it's only $14 a month or $6 a month to go for YouTube Plus, but cumulatively, that's $200, $300, $400, $500 a month. That makes a huge difference one, on your servicing, if you want to go and get more debt, but two, just on your lifestyle. And I guess part of that, I want to ask you, how are you noticing the banks are treating servicing? I know that when we've worked together, banks kind of change the way that they compete for debt. And are you noticing that, with interest rates increasing, there are different players coming to the industry that are offering lower debt to income ratios or more flexible servicing arrangements, or, counting, the income from your investment property more appropriately? Are there things that are shifting for that competitive, instead of just rebates, are there other ways that people are fighting?
100%. So if we talk about, the market we've just been through where interest rates are 2%, okay, the traditional lenders, they generally add 2 or 2.5% buffer on top of the interest rates that they're providing at the time, and that was their assessment rate. But when we were 2.5%, assessment was at 4.5%, which was crazy. It's too cheap. The median interest rates for Australia, believe it or not, around about 5.5%, which is where we're today. So while we're beating ourselves up and saying these interest rates are crazy, that's a conversation we'll have in a second. So firstly, the assessment rates that were used by the banks had to increase, and the banks have been assessing interest serviceability at sort of 6%, 5.5%, even through the 2% interest rate environment. They were forced to do that because of the APRA regulations. Okay, now that's an important piece, because ASIC, who regulate non-banks, non-ADIs, so I'm talking now about your Peppers, your Liberties, who get their funds from securitizations, not deposit holders. They've got a lot more flexibility on how they manage assessment. Okay, so and they can actually not make up their rules themselves, but they can formulate a serviceability calculation which they feel is appropriate. So lenders like Liberty, they do 1% buffer to assess. They do actual repayments on non-refinanced interest rates. So again, you can see immediately if that's 1% on 5.5%, it's 6.5% or 7% assessment rate, rather than a main bank, which is 2.5% above sort of a 5.5% rate, which is an 8% rate right now. So that 2% differential with non-banks and banks is a big factor. Like I said before, there's a lot of clients who have got a prime loan. So what I'm talking about now, good serviceability, low LVR, strong property, demonstrate affordability. They're moving to the second tier lenders like the Liberties, Peppers, who are classified as solutions lenders right now, to take advantage of that affordability piece where they can't get access to credit at their existing lenders. And again, we're talking about clients tighten up their budgets. So, debt consolidation, get rid of short-term credit, things like credit cards on 10, 15% interest rates, car loans, which are now sort of 10% again. You can roll them into a sort of a 6% rate on a home loan, and then have that debt consolidation piece and get cash flow set back again.
Yeah, that's really good. And I like how earlier, just to reference earlier, that even with some of your clients, you're looking at extending the loan term. And a lot of people don't think about that you've got your loan term, you may have had it for 10 years and it was a 30-year loan, now you've only got 20 years left. But by extending that loan term, it lowers your repayments, which manages your cash flow. The other thing that I thought was interesting is you're talking to solution lenders or non-bank lenders, and the fact that they can then take your debt at the current rate rather than adding the serviceability or the serviceability buffer. I find that interesting because I've spoken to a lot of brokers and clients, and they're saying, my client has a loan with CBA and we can't refinance them back with CBA because they don't service.
Credit locked, yeah, for sure. It's crazy.
Cool. Chris, so the question I was going to ask is, what are your predictions for banks' interest rates over the next 12 months?
Okay, yeah. Look, I think this year we're pretty much stuck in this, 5.5%, 6% interest rate environment for the next few months. I do believe the RBA will slow down a little bit on the increases. Maybe we're due maybe 1 or 2 more, but I honestly can't see how, on the flip side of that, the cost of living has accelerated and these interest costs are impacting confidence and also consumer spending. We saw the retail spending was low yesterday in a report, or the day before, so that will all impact. And also that there is a massive swag of lending which is actually still on the 2% rates, which is maturing from these really cheap fixed rates. And the next I believe between sort of June to the end of the year, there is a big billions and billions of dollars coming off those extremely low rates. So again, we haven't really seen the impact of this increased interest rate environment to its true effect yet. And I think, number one, confidence from a consumer is really bashed right now. Clients don't know whether they're getting a good deal or a bad deal. They're struggling with household, debts, as well as things like, your electricity prices, fuel prices, gas prices, all extremely expensive now. So again, just I think we've got 6 months to sort of see this through and get back to a normal environment. The forecast is next year that inflation should be back down to more median levels, and I'm talking, even if it gets down to sort of 4%, that's a good level. And the RBA's work that it's doing right now to cool inflation, I think, is a good thing for us as a collective next year. It's a bit of a bad tasting medicine to take today, but I think it will help us all collectively next year. There's obviously valves in the marketplace, extremely tight employment right now. We start to see the shoots of increased income as well, which is great. So people are, again, able to get back to more normal spending habits again, with bonuses and things coming back into vogue. So I think this year really we're in a purgatory period. Next year, I think interest rates potentially will be reduced. We'll be back in a bit more of a, I suppose, a normal environment. And if I say that, a normal environment, sort of where we were 5 years ago, when things were a little bit easier. 5% interest rate is still a good rate. And interestingly, on our books right now, we've got a swag of people looking to buy. We've got the biggest amount of pre-approvals we've had in our business for a year, which is crazy, right? So when you talk about, all this doom and gloom, there are lots of people here who've, got income, they've got savings, they wanted to find a new home or buy their first home. And we've got a lot of people waiting for the property market to sort of have a little bit more volume in the opportunities in the marketplace,
Yeah, I saw the latest numbers coming out of the ABS is that there's a huge amount of people getting pre-approved, and there's a huge amount of new loans. First home buyers are in the market, and property prices, we've had 3 consecutive quarters now, 3 consecutive months of growth. This is 1 full quarter of positive price growth, largely led by Sydney. And funnily enough, it's the top end of the market. They've grown by about 3% over the past month. So there are a huge swag of buyers, as you'd say, and there's just no stock. I think we're about 20% below the 5-year average. So this is no property market. That is what's out there. Chris, I want to ask you a funny question.
Okay, go.
Doesn't have to be a funny answer. Let's try. We are on in a public forum, so just bearing that in mind when I ask you this question.
Okay, all right.
We haven't had 15 beers, okay?
Yes.
So what is your LFYP? That's a lesson for young players. I say that amongst my friends and we laugh. It's a story about a time where you fucked up and you learned a valuable life lesson. Don't tell me about any crazy trips. Don't talk me about any midnight shifts. Just, what's a story of a time where you fucked up, you learned a valuable lesson, and you walked away from that a changed man?
Okay, yeah. I mean, I've got a really personal story. Okay, and it's probably Look, I have, when I was a young fella, had 3 kids. Okay, I just joined a financial planning group, which eventually became a partner in. And one of the financial planners there, I went through my, my statement of advice. I went through my, my restructure of my debt. I took all of this advice on. I had this document there, which was fantastic. And it was all of the things I needed to do to be financially fit. Okay. Now, one of the biggest things through that process was that clearly I hadn't got enough insurance to protect my family in the event something went wrong. And secondly, I hadn't got a will and estate plan in place, right? And I'd got some assets, but not a great deal, but I'd got assets, okay? Anyway, the advisor at the time, he kept saying, Chris, you've got to sort your stuff out. like you got to get your insurance sorted. You've got to do this. I'm going, yeah. And I got a swag of paperwork on my desk, collecting dust. And every time the advisor came round to me, I go, yeah, look, I'm going to do it. I'll do it this weekend. Anyway, it was Christmas time, driving up to my mother-in-law's place. We were in our old Honda CRV. My mother-in-law lives up in Whirlwind, where it's a really hot summer's morning, and the roads were really hot. And we usually go down the back road down into Yamina, on the old Whirlwind Road there. Anyway, driving along, 3 kids in the back, went round a corner, which is one of those corners which is quite a long, blind corner. The car just lost traction because we'd had a bit of rain on the morning road, and we went round this corner. I'm driving, Kelly's next to me, 3 kids in the back, and basically I lost control of the car. So I'm going around this corner, and the car's drifting over to the other side of the road, on the blind side of the road. And then I got round the corner, and I'm thinking, oh my God, right? So no cars were there, which was unbelievable. And then I lost control of the car, and we started spinning down the road. And in that spin, I'm seeing Kelly, and I'm seeing her hair, and she's going, oh my God. But as we're spinning, I'm seeing the kids as well, and then they're going, oh my God, oh my God. Anyway, we slowed down eventually after the spin and came to a really soft bump against this fender, right? Got down the hill, got to Yamina, and like I basically had to sit in the car for like half an hour and drink a couple of beers just to kind of settle my nerves. And then all I could think of was that piece of paper on the desk. My life insurance and my wills and estates weren't in place. And if ever I had an accident like that and one of us was injured, it's my, I have to be accountable for those kids, So on the Monday, I went back, filled in the forms, got my insurance sorted, and I went to see the solicitor and got my estate planning in order as well. There you go.
It's funny you say that. One, I didn't know that story. I'm glad you're still here. And 2, it's funny you asked that question because I'm looking at buying some. I'm always looking at buying something. But anyways, yes. It was last night, 11 o'clock at night, perfect time to have a conversation with your fiance about spending millions of dollars on a home. And I was describing how my grand plan of buying this house and da-da-da-da-da. And she said, Dom, it just feels like a lot of debt. And what if you die, get sick, hurt yourself, blah, blah, blah. I said, Charlotte, I'm insured. I've got my life insurance, total and permanent disability, I have trauma, and I have my income protection, all from the days when we started working together. And I didn't realize the value of what I was doing then. But now that I've got a 15-month-old baby, I certainly understand the value of what if that proverbial bus comes around the corner. So good advice, and thanks for sharing that story, Chris.
Anyway, yeah. Kelly made me fill the forms in on Monday. She was, she needed to be a wealthy lady one day. There you go. Yeah. Anyway, cool.
Last question. I know you're a busy man. Last question. This is a shameless plug for my book. You won't fuck it up. In all good bookstores everywhere. You missed my book launch, but I won't hold it against you. So what's the one piece of advice that you would give new investors and homeowners so they don't fuck up their next property purchase?
Oh, look, I think when you purchase your first property, you're super nervous. You're doing all your numbers. You think you're doing all the right things. With all the hindsight, I feel, what was the message that Ray Albrighton used to say?
Bite off more than you can chew and chew like fuck.
I think that for me resonates big time. When you're young and you've got double incomes and you're doing this planning, you've saved up that deposit, make that first home the best it can be. Even if it means you've got to save a little bit more, buy something a bit bigger, buy something more appropriate, and then really work hard on your plan for whatever that short period or long period is. But yeah, I think when I was younger, we missed out on places in Coogee. We tightened the budget. We were trying to be sensible, and for the first home, I think you have to have a real good crack, because it's a primary asset and an anchor asset for the next 20, 30 years for you.
I think that's really good advice. I talk about that actually in the book, that one of the lessons I've learned is to bite off more than you can chew. I mean, sometimes biting off more than you can chew, you'll end up chipping a tooth. You may not come out unscathed, and you certainly need to plan for the worst. But when it's that first, second property, buy something a little bit bigger, push a little bit harder, because in a decade or 20 years from now, that asset, $50,000 more, $100,000 more compounds over a decade or 20 years. It's tremendous. And markets that you could reach back then suddenly become unattainable. Just you mentioned Coogee. Coogee 20 years ago was a stretch for a lot of people, but those same people, if they didn't buy it then, they're not touching Coogee now.
Yeah, exactly. Yeah. When Kelly and I were buying our first place, a Coogee place was going, a 2-bedroom lock-up garage in Coogee was going for 550, 600, right? We could afford it. We had the approval for that amount, but we decided we didn't want to stretch ourselves. We went for a $500,000 property down in Drumorn instead. But that Coogee place today is worth probably twice as much as a Drumorn place today, and would have been a great property, for us long term.
Thanks for that, Chris. I appreciate all the storytelling. It's one of the reasons why I love you. And the stories get better, ladies and gentlemen, the later the stretches. Chris, thank you. For everyone out there, Chris Booth, Lydian Finance, excellent businessman. If you're a financial planner, if you're in the professional services, reach out to him. His team are excellent. And if you're just looking for a loan as well, thank you very much for joining us on the show today.
Thank you, Dom. And big plug for Wealthy and what you're doing with your book as well. Look, sorry I wasn't there, but I know I've got a little mention in there. I've skimmed through and found my little section. So thank you.
Yeah, you got a couple of mentions. I even had a speech about you, even though you weren't there. Nonetheless, everybody, happy investing, happy house hunting. I'll catch you all later.